What is going on, traders? Welcome back to the Traveling Trader. In this video, we're going to be talking about everything Apple related. Well, not everything Apple related, but everything Apple stock related. Should you buy Apple stock now? And what are the best Apple stock trading strategies moving forward after the iPhone 12 event premiered this week? And I will also highlight for you our Apple trade that netted us 100% profit leading up to the iPhone 12 event. And please know that I showcase my previous trades not as a way of boasting or showing off, but merely as a way of potentially expanding your trading horizons and giving you ideas on how to trade stocks and options moving forward. So let's get right into it. Apple just unveiled its all 5G iPhone model lineup, and it's expected to be one of the largest upgrade cycles in the phone model's history. It boasts an all 5G lineup with various price points and features to fit all budgets and users alike. Now, this is not a tech review channel, no knock on them, so I'll be mostly highlighting whether you should buy Apple stock right now at current prices and how to trade Apple stock moving forward post the event. In part 1, we will focus on Apple's fundamentals and how the new iPhone lineup contributes to those. In part 2, we will take a look at the charts and the technicals. And in part 3, I'll go over the potential trades and highlight our 100% profit trade leading up to the iPhone event. But before I do, go ahead and hit that thumbs up button, the big fat one that looks just like this, and leave it in the comment section below whether you are already in an Apple position, what your cost basis was, and if you're not in a position, whether you're waiting to buy the dip on Apple stock. And if you want access to all of my stocks and options trades, all of my portfolios, link is in the description below. So sign up. It's a great value. We have over 800 traders discussing strategies, options, entries, exits, stock ideas, etc. So sign up. Link is in the description, and let's get right into it. Part 1 of this video, Apple stocks fundamentals. So it's no secret that Apple is one of the highest revenue generating companies in the history of the world. It has been consistently clocking over $200 billion in annual revenue over the last 5 years. Its brand loyalty and the demand for its products are so strong that the pandemic did very little to deter those retail customers from shelling out that cash. As a matter of fact, Apple's revenue in every segment soared during the pandemic, beating earnings expectations in July by 14%. It is also the first $2 trillion market cap company in the world's history. It pays a regular dividend at an annual yield of just above 0.5%, so respectable, but not great. But it has a 10.5% dividend yield growth over the last 5 years. So with all that said, it begs the very important question, how much more growth can Apple as a company and as a stock sustain? Well, as we stated earlier, analysts are expecting this iPhone's upgrade cycle to be one of the largest, if not the largest in company history. If so, we can likely see Apple's annual revenue crack the $300 billion mark. But it is already a $2 trillion company, and its price to book ratio is among the highest of its peers. And if we take a look at its PE ratio, it's comparable to a lot of big players in its peer group. We're talking Microsoft, Facebook, and Google. They all have a PE ratio in the mid-30s. So in my opinion, the $140 price point that Jeffries attributed to it recently is not only reasonable, but it's realistic. We hit almost $138 in the beginning of September. So that would mean about a 15% increase from where we are currently, which is around the $120 price range at the time of this recording. So let's move on to the technicals, take a look at the charts, and then we will talk trading strategies. Okay, here's Apple's one-day chart, and if we take a look at it, it looks like a lot of stocks in the NASDAQ. If you take a look at Apple, it's forming this accumulation pattern, this rounding bottom at the top after it hit all-time highs. Same as Microsoft, same as Netflix, really. If you look at Tesla, almost the same kind of accumulation pattern, although it's lasting a little longer. Amazon, same thing. After these NASDAQ stocks hit all-time highs because of record-breaking earnings during the pandemic, we see now a retracement of about 20 to 25% on each stock, and Apple is no different. We tanked about 25% from all-time highs that we hit in the beginning of September. And what we tend to see with these retracements is that the stock finally makes its way back to those all-time highs, forming this rounding bottom pattern. You see this time and time again, whether you're looking at an index or you're looking at, one of the NASDAQ stocks that I just highlighted, where a stock hits all-time highs, there's some sort of disbelief. There's also a lot of profit taking. There's also a lot of sell the news type of sentiment there. This one specifically came right after the stock split, where traders and investors like me were taking profit, leveraging a situation in which there were mass FOMO buyers, and we were literally dropping our shares at the all-time high for those who were FOMO buying at the all-time high. Now, there are really two main reasons in my view why a stock rallies in the short term. One is an unexpected catalyst. So you see this this gap up here after Apple unexpectedly beat earnings during a pandemic. That is because it was unexpected. And two, if there's an excessively exaggerated drop, then we tend to see the stock rally back to hit those highs. So in this case, when Apple hit that 138 price point in the beginning of September and it dropped 25%, are we expecting that Apple is really 25% less valuable almost overnight? No, of course not. It was basically an overreaction due to a lot of traders again taking profit and that causing a panic selling situation. Apple's definitely not 25% less valuable within the matter of a few days or weeks. So because we have earnings coming up at the end of October, iPhone 12 orders will start to rack up, and because we saw this exaggerated drop from all-time highs, I do think we will get back to the 140 range in due time. All right, let's move on to point number 3. Should you trade Apple stock now, and what are some Apple stock trading strategies that we can leverage moving forward? Well, if you're a longtime viewer of the channel, you know that I always advocate buying the dips on major moving averages, especially on growth stocks, value stocks, or stocks that are in insane momentum like Zoom or Datadog. We recently bought dips on Apple when it hit the 50 moving average, Amazon when it hit the 100 moving average, Tesla when it hit the 50 moving average, Microsoft when it hit the 100 moving average, and Netflix when it hit the 100-day moving average. This is one of the easiest trading strategies that one can do, but it takes a little bit of practice to buy something as it is losing value and not FOMO buy when something is rallying like crazy. So in this case, it is no different. You either wait for a major moving average on Apple before buying, or you dollar cost average. Dollar cost averaging means buying the same amount on a scheduled basis. So you might buy, $100 worth every week, or you might buy 5 shares a month, whatever is in your budget, but you would essentially buy a stock that you really want to own for the long term, and you would dollar cost average. So whether the price is 120, 110, or 140, you are getting the best average price long term. Now, one thing to understand with Apple is it is a slow growing stock. Like Microsoft, like Amazon, you want to keep these in your portfolio for a very long time, and you want to try to get the best value or the best price. So yes, you could definitely buy at 120, especially leading up to earnings at the end of the month, where, like I said, I think we will hit that 140 range soon, barring a major market crash, of course, or some sort of contested election or some sort of black swan event in that regard. So that continues to be the primary focus and goal, building a long-term portfolio with stocks that we purchased at value pricing. All right, so aside from dollar cost averaging and or buying the dip for the long term, what you could do in the short term is utilize options. Now, if you know how to trade options, it really opens up the door of possibilities for what you can do trading wise and how much money or income you can generate on a regular basis. So a really easy trade you can make is you can wait for Apple's stock price to either hit close to that 140 ceiling or come back down to support at maybe around the 50-day moving average, and then leverage either calls or puts to take advantage of it. So when the price drops, the price of puts go up. So you can sell a put spread and take advantage of inflated put price. So say, for instance, Apple stock price does a slight dip, goes to the 50 moving average. Well, you can come here in the Thinkorswim platform or use Robinhood or whatever, and let's just say that you pick the November 13th options and you go down to below the 50 moving average. So the 50 moving average currently is around 115. So say you pick, strike prices below that, you can say sell the 110, 105 put spread on Apple, and if Apple stays above 110 by expiration, you get to keep your entire amount, the amount that you sold the put spread for. Right now, we're getting 95 cents for the 110, 105 put spread, but effectively, if Apple does retrace back down, then we will get a lot more than the 95 cents for this 110, 105 put spread. So that is one other idea you can do, is sell a put spread when the price dips. Now, if Apple's price goes up and starts retesting this 140 ceiling here, well, then you can actually sell a call spread, because if it hits 140, how much more is it really going to go past that? So once it hits 140, then the price of all of these calls will be increased, right? Because as the stock price goes up, the price of calls go up. As the stock price goes down, the price of puts go up. So if Apple does hit that 140 range, then the price of the calls will be inflated, and you can then sell, you know, say maybe the 150, 155 call spread. And if Apple doesn't go above 150, then you get to keep that entire amount. Right now, we're getting horrible credit for this, obviously, because we want to essentially deploy the strategy when Apple does see a price rally. Now, lastly, the other thing you can do is sell an iron condor on Apple. An iron condor is a neutral strategy where you have calls and puts and you have this range in the middle. And if Apple ends up in the middle, then you get to keep the entire amount. So essentially, here is what an iron condor looks like. In this case, we have a range between $110 and $135. And if Apple's anywhere near here, then we get to keep $162 per contract, since we sold this iron condor for $1.62. And that's the beautiful thing about options, that you can actually make money during neutral times, and you don't have to be significantly right where the stock price, you know, has to rally significantly or drop significantly for you to make money. You can essentially take advantage of any sort of, you know, sideways movement in the stock, and if it falls within that range, and you get to keep that entire amount. All right, and lastly, our 100% trade, what do we do? Well, on this date here, this was September 3rd, and again, I sent this out in the trade alerts, and if you want access, link is in the description. On this date, when Apple had an 8% drop, the value of put options skyrocketed, as well as the implied volatility, right? Because this was a large drop. So essentially on September 3rd, we sold the $90 puts for $2.45 or $245 per contract. And when you sell a cash covered put, that's essentially telling the exchange that, hey, if Apple drops to $90, then I'm happy buying 100 shares of Apple per contract. If it doesn't hit $90, then we get to keep that entire $245 per contract. So essentially, you are getting paid to wait for the dip on Apple. If Apple drops to $90, for sure, everyone and their mom is going to buy Apple. But in this case, you're taking insurance and saying, hey, if Apple doesn't fall to $90, then I get to keep $245 for waiting. But if Apple does go to $90, then I get to buy Apple at $90, which is a welcomed opportunity. And the reason I chose $90 is because it was well below the 100-day moving average here in the yellow. And obviously, Apple jumped back to 125, and we got to close out that options position for almost 100% profit. All right, guys, that is it for this video. If you got anything out of this video, leave it a big fat thumbs up. Sign up if you want access to the trade alerts. Subscribe to the channel, hit that notification bell, leave it in the comment section below. Let me know if you're an Apple or if you are currently waiting for more of a dip. Follow me on Instagram if you want to see videos and photos from my travels, as well as some portfolio updates as well. And follow me on Twitter. Stay safe out there, traders. Peace.